You're scrolling through the news. One headline says the economy is booming. The next says we're on the edge of collapse. One expert says everything's fine. Another says we're toast. You're sitting there with your savings, your investments, your job, wondering if you should panic or if this is just another false alarm. Here's the reality. We're in one of the strangest economic moments in recent history. The economy grew at 4.3% in the third quarter of 2025. That's massive. That's boom territory. But unemployment is the highest it's been in 4 years. Hiring has flatlined. Wages are stagnant. So which is it? Are we thriving or are we dying? Welcome to 2026, where the recession debate is raging and financial experts are split. Some say we'll avoid it. Some say we're already close. Some say it all depends on things that are completely out of our control. So let's break down what the experts are actually warning about, what the real risks are, and most importantly, what you should do with your money right now. By the end, you'll know if a recession is coming, what could trigger it, and how to protect yourself either way. The baseline. Most experts say no recession. Let's start with the good news. Most economists don't think we're heading into a recession. The National Association for Business Economics polled forecasters who projected 2% GDP growth for 2026. That's solid. Not amazing, but solid. RSMUS put the recession probability at 30%, down from 40% earlier. JP Morgan sees a 40% chance, but they also think we'll avoid it as long as nothing else goes wrong. The consensus is cautious optimism. Growth will slow, but it won't reverse. We'll muddle through. Deloitte predicts 1.4% growth in 2026, which is anemic but still positive. Bloomberg economists forecast 2% growth with a 30% recession chance. Mark Zandi from Moody's says we'll get through 2026 without a downturn, but he adds a terrifying caveat. Nothing else can go wrong, like nothing. We're pretty much on the edge. So the baseline case is no recession, but that baseline assumes everything goes right. And as we all know, things rarely go right. Warning number 1. The AI bubble could pop. First major warning. The entire economy is being propped up by AI spending. Deloitte warns that a drop in AI-related spending could be enough to push the economy into a recession. Other parts of the economy are strained and can't make up for lost AI activity. Let me explain what this means. Businesses are pouring money into AI infrastructure, data centers, chips, software. That spending accounted for half of all economic growth in the first half of 2025. Half. Before 2019, it was only 10%. So we've gone from AI being a small slice of the economy to being the main driver of growth in just a few years. The problem? Nobody knows if any of this will actually pay off. Companies are spending billions on AI with no clear path to profitability. It's speculative. It's based on hope and hype. And if investors lose confidence, if AI stocks crash, if companies start cutting back on AI spending, the entire economy could tank. 50% of economists surveyed by Bankrate expect above-trend growth in 2026, and almost all of them cited AI as the reason. The AI and data center boom will lift business investment and GDP growth, they say, but that's a massive concentration risk. If AI falters, we're done. Warning number 2, the K-shaped economy is getting worse. Second warning, the economy is K-shaped. That means rich people and AI companies are doing great. Everyone else is struggling, and that split is getting worse. EY predicts that consumer spending will remain uneven in 2026. High-income households will continue to drive spending, while lower-income families remain under pressure from high prices, slow wage growth, and elevated borrowing costs. Gregory Dacko, chief economist at EY Parthenon, warns that lower-income households face intensifying pressure from elevated prices and interest rates. Why does this matter? Because economic growth needs a broad base of consumers spending money. A handful of rich people buying luxury goods isn't enough. And here's the scary part. About 1 in 3 adults believe their finances will get worse in 2026, the highest level since 2018, according to a Bankrate survey. People are pessimistic. They're scared. And scared people don't spend money. They save it. They hunker down. And when spending stops, so does economic growth. Warning number 3. The labor market is frozen. Third warning. The labor market is stuck. Hiring has flatlined since summer 2025. Wage growth is slowing. Unemployment is at a 4-year high. And nobody knows if we're about to see a pickup in layoffs or a recovery in hiring. Normally, 4.3% GDP growth means rapid hiring and big raises. Instead, we've got an economy that's supposedly booming but feels like a recession for workers. Jobs aren't growing, paychecks aren't growing, and people are getting anxious. Experts at Bankrate note that usually avoiding a recession means more employment and faster wage gains, but Americans barely seem to be reaping the benefits of a strong economy. It's like playing dodgeball, constantly ducking obstacles and unsure if you'll remain standing. And the labor market is one of the 4 pillars holding up the economy, according to Moody's Mark Zandi. If it falters, we're toast. If companies start laying people off instead of just freezing hiring, consumer spending will collapse. And when spending collapses, so does the economy. Warning number 4. Inflation is still a threat. Fourth warning. Inflation isn't dead. Our SM expects inflation to remain well above the Fed's 2% target in 2026. The ING sees inflation as a persistent risk, especially if there are oil price spikes or fiscal stimulus that overheats the economy. President Trump is reportedly pushing for $2,000 tariff rebate checks to 150 million Americans. That would inject massive stimulus into the economy, similar to COVID-era checks. It could boost spending, or it could reignite inflation, forcing the Fed to hike rates again, which would tank the economy. And don't forget about tariffs. Even though trade tensions have eased, tariffs are still elevated. Companies are passing those costs to consumers. Prices are sticky. The Fed might have to keep rates higher for longer to fight inflation, which would put more pressure on businesses and households. If inflation stays above 3%, the Fed can't cut rates aggressively. That means borrowing costs stay high. Mortgages stay expensive. Credit cards stay at 25%. And consumers get squeezed harder. Warning number 5. Volatility and uncertainty. Fifth warning. Uncertainty and volatility are through the roof. Bankers surveyed by American Banker said regulatory volatility is a prime concern. The dismantling and whipsawing of regulations under the Trump administration has left businesses unsure of what rules they will be operating under. And tariff volatility remains a threat. The recent U.S.-China truce is fragile. Any miscalculation could derail the deal, bringing back the trade war chaos that disrupted global supply chains in 2025. One bad decision, one geopolitical shock, one unexpected crisis, and the whole house of cards could collapse. The economy is running on a razor's edge. Moody's puts the recession risk at 42%, saying that in a healthy economy, that number would be around 15%. We're not in a healthy economy. We're in a fragile one. What you should do right now. So what does all this mean for you? How should you position your money if a recession might or might not happen? First, build a bigger emergency fund. If experts are saying we're on the edge, take them seriously. Aim for 6 months of expenses in cash. If you lose your job or face a financial emergency, you don't want to be forced to sell investments at a loss. Second, don't panic sell your investments. If you're invested for the long term, stay invested. Recessions are temporary. Markets recover. If you sell now out of fear, you lock in losses and miss the recovery. Just look at COVID. People who sold in March 2020 missed the massive rally that followed. Third, reduce high-interest debt. If a recession hits, you don't want to be carrying credit card debt at 25% interest. Pay it down aggressively. Free up cash flow. Give yourself breathing room. Fourth, diversify. Don't be overexposed to AI and tech stocks. If the AI bubble pops, you don't want your entire portfolio to crater. Spread your money across sectors, geographies, and asset classes. Boring diversification saves lives in downturns. Fifth, lock in income if you can. If you're thinking about switching jobs or negotiating a raise, do it now while the labor market is still semi-functional. If layoffs start, opportunities will disappear fast. So, will there be a recession in 2026? The honest answer is nobody knows. Most experts say no, but they're not confident. Recession risk is somewhere between 30% and 42%, depending on who you ask. That's way higher than normal, and it all depends on things that are mostly out of our control. AI spending, the labor market, inflation, trade policy, regulatory uncertainty. Mark Zandi said it best. Nothing else can go wrong. We're pretty much on the edge. That's where we are. Balanced on a knife's edge, one shock away from falling into a recession, but also one good development away from accelerating growth. The K-shaped economy is real. If you're wealthy, if you work in AI or tech, if you're in the top 20%, you're probably doing fine. But if you're working class or middle class, if you're living paycheck to paycheck, if you're feeling the squeeze from inflation and stagnant wages, this economy feels like a recession already. So don't wait for economists to tell you it's official. Protect yourself now. Build that emergency fund, pay down debt, diversify your investments. Make smart decisions with your career because whether we technically enter a recession or not, the risks are real. The economy is fragile, and you need to be prepared. The experts are warning you. The data is flashing yellow. Don't ignore it. Take action, protect your finances, and ride out whatever comes next. Because recessions are temporary, but financial mistakes can last a lifetime. Stay smart, stay prepared, and whatever you do, don't panic.